Everybody, good afternoon. Welcome to 12-Minute Trading. My name's Doc Severson. I'm joined here by Dave Lukas of 12-Minute Trading as well, too. Today is Monday, the 9th of September in 2024, and we have seen some fireworks for the past 2 months now. So we could be transitioning into, this is either the very beginnings of transitioning into a corrective market, also known as a bear market, or it could just be a pause before the next swing higher. So that's why we have the roller coaster thumbnail for today. So Dave, what are you seeing out there in the markets?
You know, it's we've talked about this. We've been talking for a matter of weeks, coming into last week, saying, "Hey, there's a massive move on tap. The daily energies were as charged up as they've been in the last few years, and to expect a big move." And you never know the direction. We said we anticipated maybe it going higher, getting everybody on board before it got faded, and that would come later this month after the Fed. It looks like we're just doing the opposite. It looks like we've just sold out ahead of the Fed and front ran it, and the back half of the month into October may be higher. So today's kind of a technical bounce. We've come down the lower Bollinger Bands on the charts, on the daily charts. We're bouncing off of those. That's very typical. It's what we normally would see after 4 or 5 days of selling, like we saw last week. And so now it becomes, do we just go sideways and find support in a bottom here? Or is this just a bounce for a little bit and then we just roll back over and complete, that move down? Because there's still a decent amount of energy left in these charts. We're, more than halfway through, but there's still plenty. We can go another 200 points lower easily and go to those August lows on the SPX. So we're kind of going to have to see. We've got a few things going on this week that are going to really affect it. We've got the debate tomorrow night. That is, I think, going to affect the markets. The outcome of that, will affect the markets. Like in the outcome being, if Trump blows it somehow, markets, I think, could sell off from that. Because they are pricing in a Trump win as of right now. We've got CPI, PPI this week. You and I've talked about this, that with the Fed already making the decision and just saying, hey, we're cutting rates, does CPI, PPI mean as much anymore? Maybe if it comes in really hot, maybe it does at this point. But if it comes in line and like it has been, I don't think it does. I think even if it came in hot, the Fed is still going to cut rates, but there's been kind of a little bit of, I think it was like 50% that they were going to do a 50 basis point cut. So that would be off the table. Maybe it's 25, right? And it is amazing that little teeny 25 basis points, right, is going to make all the difference for the market, and that's why a lot of times after these things happen, you don't necessarily get the reaction that you'd think. And that's why a lot of times once the Fed starts cutting, if they start getting more aggressive, the market sells off in the coming months because it is leading into a recession. Last point, the 2 and the 10 have reinverted the other way. So that's usually at the time where you see a recession, right? So longest, like it was 1,000 days or something that the 2s and 10s are inverted. Now they are crossing back the other way. And so that typically is a sign that the bond market is pricing in that recession ahead of time. So now the 10 is worth more than the 2. So those are just some things that I think are important for this week. How about you?
Yeah, let's. I'm going to bring up the charts here, and I'm actually going to go out to the ES for this. This is the S&P 500 futures, and even though this is a little bit of a mess here, what I'd like to show you is how the price came down on Friday. I know this is difficult to see, but if you consider the Fib retracements from the very bottom on August 5th up to the very top up here on this consolidation that we had in mid to end of August, we on Friday, right at the very close, not even at the cash bell, but it was like in the hour or so after the cash market closes, the futures will trade a little bit on Fridays until I think it's, what's that?
Every day. Till 5 p.m. every day they continue to trade.
Yeah. So this one finally went down to the 50% retracement, which is, so we got all the way up here right down to 50% retracement. So you could even see this like on the intraday chart over here. Look at this little move here, just right down, doink, right there at the 50% retracement. And then we've seen a nice bounce since that point. And I think part of that bounce was due to Janet Yellen doing her, cheerleading over the weekend. And, the markets always like to hear of either the Fed or some kind of government body saying, hey, we're getting those printing presses warmed up.
Typically Yellen, when things get like this, comes out and has some way of promising liquidity to the markets. And the market, it's a VIX crush every single time she does that. And so you look at the, you had it up there even on the ES. If you look at the daily chart with the energy, look at the energy turning back higher. So, can't take too much off that yet. One day's, one day, but typically, that may be signaling that we kind of have found at least a shorter term bottom right now.
Yeah, we could. So what's happening is exactly what the market wants, because the market was getting super exhausted on a longer term chart as we got into the springtime. And these moves, this is why on the monthly chart, I say, don't pay attention to these exhaustion levels, because they can go for a long time, for months before they finally reverse. But the price is coming back, and it's allowing the monthly chart to finally restore itself, which is what you need before you set up the next big move, whether or not that's to the upside or the downside. The weekly chart, now this is what's really interesting to me, because we're making a clear transition from this is a quiet and trending market. We had a little bit of a hiccup here in April, but right back to it all the way up to mid-July. And then since that point, we've been slamming around.
Look how
like
noisy
this,
it is.
right? And this is your classic transition from quiet and trending to sideways and volatile.
Hey, Doc, it looks like you need to boost my audio. People are saying they can't hear me.
Oh, yeah. I forgot about doing that. All right. All right, there we go. There's more Dave.
How about now, guys? Better?
There's more Dave.
More, yeah. That's what we need. More Dave. You guys type in the comments if you guys can hear me. Sorry about that.
Yeah,
So,
I guarantee it's much better now. So this is a classic transition from, quiet trending markets into sideways and volatile. Now, what you guys have to understand from this, I guarantee it will be, it's much better now.
YouTube has a little bit of a delay. It'll catch up.
Yeah, it takes a while. One thing that to understand with this is that when you have sideways and volatile like this, one of two things can happen. Either we transition back up to another uptrend, just similar to this. If you need to see what that looks like, go back to the pandemic move, and we had exactly the same thing, right? So September, October during the pandemic, we had this same kind of move showing up, and it broke out to the upside again. Or we've got a 2022 move like this, where we actually transitioned to the downside. The next bear kicked in. And so, of course, we are extremely, we're following this thing as tightly as we can, because we want to know, like Dave's saying, we've been talking for the last 6 months about, hey, this market's in trouble. We're probably going to have a very difficult 2025. It's just that before it finally gives up the ghost, a lot of times we see one final screamer to the upside. And we want to be part of that, because you can make a tremendous amount of money on those final screamers. However, you don't want to hold on for too long. This is where most people get caught holding the bag on these types of moves. So we're in an extremely important level here for the next, I'd say, maybe 6 months or so. We're going to see a massive move from this. This is going to charge up like crazy. We're going to have the potential for a really big move here, and it's going to break fast. And I would say most people are not going to be on board for this thing. Most people will get caught blindsided by the next move that comes along. And it's usually because it sets up one way and then it reverses really hard in the opposite direction. So which way is that going to be? We're not here to predict the future. In fact, I think that's a fool's errand to do that. But what we are saying is that we're setting up with a transitory volatility, and this is a precursor to a big move. And that that I believe we can take to the bank. That, I mean, these types of character transitions are reliable. They happen all the time, and they happen for a reason because of human psychology.
Yeah, we've effectively gone nowhere since June. We've been in one giant range since June at this point. If stepping back looking at it, that's crazy, right? It doesn't feel like it, but we basically have been nowhere since June. But the other thing I think people need to have perspective on is the fact that we're still up like, well over 10% across the board for the year here, guys. It's not like, we're not, I had somebody send me a note last week. Is this the beginning of a crash? No, we're not even close to that yet. So this is just normal type of action, right? When we've been running this hard this long, to have some pullbacks like this is pretty normal. What really starts to signal we are changing here is the lower highs and then lower lows. And we have not printed that yet. So maybe we've got a lower high, but we have not put in a lower low yet, right? We would have to take out the August low for us to see that, right? So that would be, we need to go down to 5,100 on the SPX, somewhere in that range to do that, right? And so that's the things that I'm watching, because this is pretty, it's choppy. It's a sign that the market is jittery, and I'm saying that because of the election. That's always a piece of it. September, I don't know what it is, but September every single year is the roughest month of the year. If you look every single year, it's the month that has the most volatility, and if you're going to get your corrections, it's just like that every single year. And I think maybe that's just human nature, right? You've done so well up to a certain point, you want to take some off the table for the end of the year. Lots of things can drive that. So you have that, right? So it's just not at a point where I'm going, oh shoot, moment has happened yet. And we'll have to see when or if that happens. But we could come right out of this and start heading straight back up again. And I would actually not be surprised to see that, because that would be that final move. That would be, and look at how perfect it is on those charts where we're charging the weekly up. It's going to take more time, right? We're probably going to be in a range into October, just before the election. And there you go. The weekly's charged up just around the election time. The election happens and boom, we get the big move, right? Into the end of the year. And so right now I would say that's still higher, because again, these big players are going to want to run this thing up and take every last cent they can get out of it before they fade retail. And that's, with rates dropping, all this money on the sidelines, guess where it's going to start looking for a home? It's going to look at other places, which may be the market. So, yeah.
There's
retail,
only two things.
Always late.
There's two things behind that retail move. First of all, number one is, they want to squeeze every penny that they can before they discard their longs that are in some of the winners right now, and then start to flip their portfolio. So that's obvious. And to some degree, they want to encourage that. They want to hey, look at this move. And really the second reason is not just the fact that they want to maximize their assets, but they also have to create a massively liquid environment where people are just climbing over each other to get on board these things.
Because of the volume that they have to drive to exit.
Right. We're not talking about, we're talking about literally billions of shares that these guys are going to want to unload. And you can't do that if it's a quiet market where everybody's just kind of standing off and watching each other. Well, I'm not going to move until he does, and those kind of things. No, you want to create a frenzy, just like the opposite condition when we're selling like crazy. Well, it got a waterfall decline. That's when they want to buy. And that's why you see these huge volume spikes show up at market bottoms like what we had on August 5th. Huge market volume. That's the type of liquidity situation where you're not going to move the market against yourself. You can literally put in millions of shares, and the liquidity pool is so deep that you're not going to move the market with even a big order like that.
Well, and the other thing about this current move, that's a good point, is we're not seeing the VIX spike like it was doing in that time in August.
No.
I mean, what's the VIX at 20? We're not getting that massive fear out of this. And that's another thing that kind of tells me that, like, we're not, really just going to roll over and fall apart here. The other thing is that typically these things end, as we're talking about, in that euphoria stage. And I don't see CNBC, popping champagne corks right now, or anybody doing that, right? So we're just, watch for that, because it is a great sign where it's like everybody and their brother all of a sudden is a trader. Everybody, you can't lose, right? Nobody can lose, and everybody's piling in, and CNBC is saying new highs, and it's like, this thing can't stop, and everything else. That's the time when you really need to be careful and make sure that you are getting defense in place and getting defensive. That's when those moves happen.
Yeah. So think about what we just went through like 2 months ago, mid-July. What were some signs that we had right before this thing fell off the cliff, right? We had, depending on what side of the camp that you're in, it's like we had a potential assassination. The guy survives and, actually ends up being stronger after that. There were some I think there were some earnings around that time as well, too, that were particularly well received. So there was every reason in the world back then to go long in mid-July, even though we're like, holy shit, this thing is really exhausted. We're not touching this thing. Look out for this kind of move, because we had serious exhaustion across the different time frames. So this is, I think we might be just in a big triangle right now, kind of like as you talked about, until some kind of certainty comes back into the market. Mm-hmm. Now, the Fed dropping rates is typically, that's, let's look at if we look at the 10-year note for this, the Fed's been dropping, or the market's been dropping rates for literally months now. Mm-hmm. If we go out to, let's see, these tickers are always such a mess.
TNX, yeah.
Yeah, it's not the TN, you got to pick the right TNX. So we've been dropping now since April. The bond market has been dropping the rate on the 10-year note since April from, about 4.7%. Now it's down to 3.7. Where's the Fed? The Fed's still around, 5-ish right now on their discount rate. So they're way behind the curve, as always, right? So the fact that the Fed's going to be dropping the rate doesn't necessarily mean anything, because they're already behind the curve. But it's really, I think, what the market's going to be looking for starting next week is, okay, now that you've started, how fast are you going to go? Are you going to catch up to the bond market, or what are you going to do?
Yeah.
Hey, guys, we're going to be here for another few minutes. If there's any other questions, or if there's anything that you guys want us to look at, now's the time before we melt off into the sunset.
Well, you have a little event you're doing on Fibonacci's and stuff this week. You should tell them about it. Maybe they want to come see you.
Absolutely. In fact, I need to get that up on the site. Let me do that while you're talking here. Let me go find that, and I'll update this.
What is it, Wednesday? Is that right?
Yeah. So Wednesday at 2:00, I'm going to be talking about fibs. And what I'm going to be doing, I'm not going to consider myself, or say that I'm a Fibonacci expert, but what I do is I do look for certain things on the fibs, such as when we're looking at markets like this, just the standard S&P. You'll see me put the fibs on here because I'm looking for things like the 50% and the 61.8 and certain levels, and those certain levels begin like guardrails to me. Much like what you talk about dynamically with the Bollinger Bands. So these are just static guardrails around price levels that everybody can see. And more often than not, we tend to see reactions at these price levels. And that's particularly important. The other thing that we can do sometimes when we get into these runaway markets where we have moves that just, go on forever like this, we can also look at fib extensions to get an idea of, okay, where's a good landing spot for this thing? When do we expect that this move is kind of played out? And so we can use fib extensions, but I don't use those that often. It's usually for moves that where we're in a runaway market, and
You
so
know,
those can be very helpful.
let's do everybody a favor real quick. While you've got that up, throw NVIDIA on there since that's been the leader of the market. I did a trade on NVIDIA today, actually, and can explain a little bit. But so yeah, throw it up there and let's see what it looks like on its fibs, and we can kind of show kind of the same type of thing.
Okay, so if we're going to look at the fibs on NVIDIA, we're going to go from the bottom of this swing up to the top, and we are just hanging right around that 61.8% retracement. Normally, if we close below this level, which is what Friday was, normally what happens is we fill in the triangle. So NVIDIA is at risk right now for coming back down to about 90. And this is one of the reasons why I had a short put for the September cycle, which was going to be expiring in a few days. And I went ahead and just closed it out for chump change on Friday, just because, if I can get a sign for even lower price, I would rather do that. So
the thing that I like on NVIDIA too, it's one of the reasons I traded today, is that energy's exhausted.
and
So
let's look at your Bollinger
I think it could do that, but I also think it could just go sideways to nowhere from here too. And I'd love to own it down in the 80s and 90s, if I can get it. So that's a nice thing that I think is important. Again, it's funny how like nobody wants to touch these stocks when they're beaten up like this, but now's the time. It's like Bitcoin when it goes to like 48. No, nobody's buying Bitcoin, but then all of a sudden 60 is great. Let's buy it, right? So it's funny how human nature works.
So we've got a question
RVX.
here about the RVX and the VXN. I spend most of my time just looking at the VIX. I spend most of my time just looking at the S&P 500 because everything else is kind of a derivative of that. But you can look at these. Let's see, the RVX. Let's look at the RVX here. In both cases, we're coming up to a lower high. So like what Dave said is that, and this is pretty common. I mean, if we go back and let's look at the VXN and let's look at some of the more, interesting moves that we've had over the past couple of years. So here was 2022. Let's go back more than that. Okay, so here's the move coming into what you can always do with these is during uptrends, look for the positive divergence on the volatility index. That's a good leading signal for where somebody knows something, right? Somebody knows something. We didn't really start selling off until first day in 2022. And this thing started moving well before that. So that's something that you can always look at, irrespective of what you're looking at, whether it's the RVX or a VXN. So now what's interesting about this one is the second spike that we had. Here's the initial spike of fear. And the second spike was almost as big, on the NASDAQ. And let's compare that to the VIX for a second. And that was the case as well too. The second spike was almost as big, even though the selling was much, much stronger. And this is typically what we're going to see, is that we're getting a smaller spike right now, but this is very common because this is the one that catches everybody off guard. Like this is the, pardon my French, the oh shit moment. And now this one is like, okay, here we go again.
Japan.
Right. So I'm ready for this one. And so you're not seeing quite the same panic for this. And, so even during bear markets, I mean, if we go back, to super bear markets, like let's go max available. And if we look at like 2008, 2009 in here, you can see that it's really peaked out in October of October of 2008. And even during the lowest lows, the worst part of it, this is the very bottom of the bear market right there. And it was significantly lower. So we're going to see that element to it. And this is just, this is just part of that. This is because everybody's become numb to the move by that point, and everybody just sort of expects things to go lower. So I don't, Jungle Cat, I don't
go the other way.
Yeah, Jungle Cat, I don't know if I've answered your question. No, I don't really look at the VXN or the Russell. I most likely just look at the VIX because I'm mostly focused on the S&P, although Dave, I don't know if you use it.
Well, it's helpful to look at like the VXN especially, because the Nasdaq typically has more volatility baked into it. That's why, like, you can get so far out of the money even during very quiet and trending times, like on the NDX or the Qs and stuff like that, is because you have that just that inherent kind of volatility in a lot of those, those fast moving stocks and stuff and things like that, right? Because they have the opportunity for these big spikes and these big drawdowns, right? And so that kind of hits that index. Another index that you can look at that I think is it's something that I'm looking to trade more and more when it comes to the Nasdaq is the TQQQ. It's cheaper. It follows kind of very similar patterns and everything else, and it's a nice way to play that same thing. I like it better than the Qs actually. So that's one to maybe put in your arsenal to look at if you want to play the tech sector. I like that one. Like I said, even better than the Qs, and for the price of it, it may actually offer better opportunities for than even the NDX at this point. So right now is a good time to look at selling puts on that thing.
The only thing that I would say on this is, obviously the scale is kind of messed up on these because, the end of 2022, was it really only worth $20 a share? So what happens is they mark to market these things on a regular basis versus the futures. And then there's some drag in there because of the contango that there's. And so these things you don't want to hold them for a long, long time.
No, I like selling options against them. This is not something I just buy and hold.
Right.
This is something you can buy it and sell calls against it. You can do like, at the money calls every week on this thing and do pretty well. But it's just, it's good for options, and I should maybe state that. So,
yeah. So like, I like doing the same thing on the I use the SSO. For the S&P 500, which is also, again, you don't want to hold these for too long just because of the drag. They don't keep up with the true root instrument for like the S&P or the spiders or the Qs, right? So we have this. There's also the QLD. This is another one, which is the NASDAQ specific. And, it just doesn't keep up with the other one. But you can, like Dave says, you can trade these on options and do some short-term trades. But once you get assigned, if you're playing the wheel on this, your job should be to, maximize the move, play the calls against it, and then, get called out. And then you can start playing the opposite side of the wheel again.
Yep.
Any other questions, anybody? We are just about out of time here. And so, again, I'll update this video for those of you that are going to watch this on a replay. I'll update this video with an invitation so you can join me on Wednesday for it's a timing research, and I'm speaking at 2:00 on Wednesday, and it's just going to be a straightforward, takeaway presentation of like, this is how I use these things. Here's the 5 basic rules to that extent of how I use fibs, especially with these big volatile markets.
And those guys at Timing Research do a really nice job on these. They're free events, guys, to attend, but they probably have, I don't know how many other traders, but focused on this, just teaching from it. So if you are interested in how to better use the fibs and everything in your trading and everything, it's a great event to attend. So yeah, grab that link. It'll be in the comments there. And then we sent it out in our newsletter last week, and we'll get, if you're on our mailing list, you'll get stuff on that too. But great event there.
Yeah, I just put the link up in our comment section. If you guys want to just
Perfect.
click on that, that's a free way to opt in for the link, and then you'll be sent the address for that. So looking good, and looking forward to seeing you guys out there. And thanks for joining us today. Thanks for your
Yeah, thanks, guys.
questions. And
Let this thing show its hand still.
Yeah.
Today's nice. If it holds and we get some support in for, 5,400 is a good level. So we'll see if SPX holds it over the next few days. We can get through the next few days and CPI and the debate and stuff, and this thing's still holding. I think we probably have at least a short midterm bottom right into the Fed. And then from the Fed, we'll have our next risk event. So we'll be here next week talking about that. Or actually, you're out next week, so we won't be here next week talking about that. We'll have to do something afterwards. So thanks for jumping on, guys, and we'll see you soon. All right.
Okay. Thanks, everybody. You guys take care. There we go. Okay, so I'll get this